Hello everyone and welcome back to my channel, and today's video is going to be on investing lesson number 2, the differences between investing and trading. There's going to be 5 main differences I'm going to be talking about. I'm going to be talking about the duration, I'm going to be talking about the strategy, I'm going to be talking about the expectation, I'm going to be talking about the analysis, and I'm going to be talking about the protection. These are the 5 main differences when it comes to knowing the difference between investing and trading, because knowing the difference between these two can help construct your financial goals when it comes to approaching the market. Because many people may have long-term goals, which is like buying a house in the next 5 to 10 years, and many people may have short-term goals where they want to make profit as quick as possible. So let's get straight into the video. Now, the difference number 1, duration. When it comes to trading, your goals are more short-term orientated. So you're looking to make profit as quick as possible, and you're looking to make profit on a day-to-day basis. However, when it comes to investing, your goals are more long-term orientated. So you're looking to buy shares and then wait a while and then make profit through dividends and other sort of sources of income that companies may give to their shareholders. So that's difference number 1, the duration. Alright, difference number 2, strategy. When it comes to trading, your strategy is to buy and sell shares on a day-to-day basis, or because there's many different forms of trading strategies that you can use. I'm going to be doing another video on that later on as well, but the easiest one is just to buy and sell on a day-to-day basis. So when you're doing that, what you're looking to do is you're looking to buy shares at a certain price when the shares are lower than normal, and you're looking to sell the shares when the share prices of that share go up. So you're looking to, say, buy a share at £5, sell it at £10, and you've doubled your money. That's simply how it works when it comes to. You can use brokerage firms like Plus 500, Trading 212. You can do it on your phone. It's mainly digital now to trade, and you can just do it on a day-to-day basis. You may see people on Instagram, people on other social media doing this as well. But yeah, it's a nice way to make money, but most people tend to lose their money because they're unaware of the risks that are in place and they're just trading blindfolded. So it's good to do research. It's good to look at market conditions when it comes to this strategy. Now, when it comes to investing, the strategy is to buy and hold. So what you're looking to do is you're looking to buy shares and then hold them for a long time until the company that you bought the shares from is performing really well. And you can either hold on to the shares and just keep claiming dividends from this company, or you can sell it at a higher price. So for example, if I were to buy 10 shares of Coca-Cola at £10, this is very unrealistic by the way, the share price is a lot more. But if I were to do that, and if I were to wait 5 years and then the share price of this went from £10 to £20 and sell it off, I would have doubled my money. So that's how that works as well. So you can make money both ways, but it depends on your goals, as I said in the beginning, and how you want to work around the market. So that's the difference number 2, the strategy. Difference number 3, expectations. So when it comes to investing, what your expectations are is that you're expecting the company to pay out good dividends. You're expecting the company to do well in the future in terms of long run. So say 5 to 10 years, even 20 to 30 years. It depends on how much time you got. It all depends on how you think the company will do in the future. So that's what your expectations are. And you hope that dividends will stay steady so that you're earning a certain amount of income every quarter or however frequently the company pays a dividend. Now when it comes to trading, you're not really concerned about dividends. What you're concerned about is the fluctuations of the share price. You'd be probably looking at the news a lot on a day-to-day basis, looking at Bloomberg, CNN, any news that reports what's going on in the market, and you'll be looking to see how certain events may affect your share price and your fluctuations. So you'll look to buy and sell shares and get into positions quick and get out the positions quick as well. So you're not really interested in the long-term goals of the company. What you're interested in is how they can make you profit as soon as possible. So that's what traders are mainly concerned with. But like I said as well, there's many forms of different trading strategies that you can look into. I'm going to do a video on that later on as well. But that's the main difference in terms of when it comes to expectations between investing and trading. One's expecting dividends and a source of income and better performance in the long run, which is investing. And trading is just expecting the share prices to fluctuate a certain way on a given day. So that's the main difference in terms of expectations. So that's difference number 3. Now when it comes to analysis, this is difference number 4. When it comes to trading, you're looking at more technical analysis. So that is using market data such as the price and volume of shares on a day-to-day basis, and using that to forecast how you're going to approach the situation, how you're going to approach the shares. Are you going to buy a certain amount of this, certain amount of that? Are you going to diversify? Are you just going to put all your eggs in one basket and hope for the best? Or are you going to just buy a certain amount of shares, leave it for a while, then sell it because you know it'll perform better at a certain time? So that's to do with trading when it comes to analysis. And when it comes to investing, you're looking at more of a fundamental analysis. So you're looking at market fundamentals such as the PE ratio, PS ratio. You're looking at many different tells that the company gives out in terms of their company reports, and you're looking to see and predict and forecast. Predict and forecast is the same thing, but anyway, so you're looking to forecast how you think the company will do in the next 5 to 10 years. Are they sustainable? You're going to look at the company's 30-year history. You're going to look at their market cap. You're going to look at their price currently, their price in the last 10 years, their dividend frequency, how well have they paid dividends, and so on, if they missed any dividend payments. But yeah, there's a lot that goes into it, and I'm going to explain more as more videos pass in terms of both types of analysis, technical and fundamental. But that's the main differences when it comes to analysis for trading and investing. One is to do technical analysis, so that's like looking at the bars, and the other one's to do more in-depth research into the company's ratios, their price to book ratio, price to book value, and so on. So you're doing more due diligence when it comes to investing than you are in trading. So that's the difference number 4, analysis. Now our last and final and not the least important one is protection, number 5. Now what's important about protection is that, of course, as an investor, as a trader, you want your money to be protected, because the worst thing that can happen to you is making significant losses when you're trading and investing, because then that's just seen as gambling. So an example of protection is that when it comes to trading, you have a stop loss order, and you also have a stop profit order, but I'll get into that as well. So what a stop loss order is that once you place a trade, obviously you're going to see the prices fluctuate, you're going to see it go up, you're going to see it go down. What you can do is you can prevent the money going down to a certain point by placing a stop loss order, and when that stop loss order is triggered, that's when your money will be pulled out, and whatever losses you have taken are limited by however much you set it. So for example, if I bought shares and I put stop loss to -£5, then as soon as it hits -£5, I've lost £5, and it could have been worse than that. So that's what a stop loss order is for trading. Now when it comes to investing, it's slightly different because you don't have that certain degree of protection. But what you're planning to do is, with this due diligence that you carried out in the analysis section, you're expecting the company to recover any losses if the company were to do badly in, say, a recession or any economic circumstances that may have caused the company to go downhill. It's all about placing faith into this company and placing trust into the management, the board of directors, and yeah, that's what. So investing doesn't have the same degree of protection as trading does, but with investing you're looking at the long term anyway. So a short term negative impact that may have occurred on the firm won't really phase you, and if you are triggered to pull your money out, then there's no point investing in the first place, because then you're just gonna take loss after loss after loss. The best piece of advice I can give you when it comes to trading and when it comes to investing is that you can't have an emotional attachment to your money, because once you do that, once you have an emotional connection with your money, anything that happens to your money is going to trigger you. It's going to make you it's going to cause you to make bad decisions. It's going to cause you to pull your money out early. It's going to cause you to have impatience and so on. So the best thing to do is let the money work for itself. Carry out your due diligence, of course. Carry out any extra research that may need to be done in terms of the firms when it comes to investing. When it comes to trading, use these stop loss, stop profit orders to limit your losses and so on. But yeah, that's the main differences between trading and investing. You have the duration, you have the strategy, you have the expectations, you have the analysis, and you have the protection. If you have any more comments about this, anything that I should have added that I missed, please add to the comments down below, and please like, subscribe, and I'll see you in my next lesson in a bit.